Hey there and welcome back to Monster Invest. I'm Daniel. Today we're pulling back the curtain on one of the most misunderstood tools in personal finance, mutual funds, not ETFs, not index funds, mutual funds, the OG pooled investment vehicle that's been quietly building generational wealth since 1924. If you've ever wondered why your parents' retirement accounts are stuffed with them, or why your financial advisor pushes them like free samples at Costco, we're diving deep. No jargon, no Wall Street fluff. Just real talk about who they're truly for and who should run the other way. Let me set the scene with someone you might recognize. Picture Alina. She's a single mom in Houston, working double shifts as a nurse. Her dad passed last year, leaving her $18,000 in cash. She's terrified of losing it. Her bank manager slides a glossy brochure across the desk. Safe growth opportunity. It's for something called the Horizon Balanced Mutual Fund. Alina sees words like professionally managed and diversified portfolio, but all she feels is panic. She Googles at 2 a.m., drowning in terms like NAV, load fees, and 12b1 fees. She almost stuffs the cash in her mattress. Sound familiar? Here's what nobody explains. Mutual funds aren't a strategy, they're a structure. Imagine 10,000 strangers, teachers, plumbers, retirees pooling their money into one giant bucket. That bucket is legally structured as a mutual fund. A licensed portfolio manager then invests that cash according to a strict rulebook called a prospectus. Some funds chase hot stocks, active management. Others blindly track indexes like the S&P 500, passive index mutual funds. But here's the key difference from ETFs. Mutual funds only trade once a day at 4 p.m. Eastern Time at that day's net asset value or NAV. No intraday panic selling when Tesla crashes at noon. No bid-ask spreads, just one clean price, calculated after markets close. And fees? Oh, we need to talk about fees. Mutual funds invented the fee buffet. There's the expense ratio, the annual slice taken for management and operations. Then there's the front-end load, a sales commission paid when you buy shares up to 5.75%, or the back-end load, a penalty for selling too soon. And the sneaky 12b1 fee, paid to brokers for marketing, even if you found the fund yourself. Let's run Alina's numbers. She invests $10,000 in a fund with a 5.75% front-end load. Instantly, $575 vanishes, gone to the broker. Only $9,425 actually works for her. Then a 1.2% expense ratio grinds down her returns yearly. Over 20 years, that small fee devours 28% of her potential growth. Compare that to a no-load index mutual fund like Vanguard's VFIAX, 0% loads, 0.04% expense ratio. The difference isn't just math, it's Alina retiring at 65 versus 72. Now who actually benefits from traditional mutual funds? Let's rewind to 1998. James, a factory worker in Detroit, gets his pension payout, $62,000. He's 58, knows nothing about stocks and distrusts that internet thing. His credit union rep recommends the American Balanced Fund, a mutual fund that's existed since 1933. Why? 3 reasons. First, it's accessible. He can buy shares by mailing a check, no brokerage account needed. Second, automatic features. He sets up 100 monthly deductions from his paycheck, no apps, no logins. Third, human oversight. When 9/11 crashes markets, he gets a handwritten letter from the fund manager explaining their strategy. James doesn't check his balance for 12 years. At 70, his $62,000 became $219,000. That's the power of mutual funds for people who want to set it and forget it without tech headaches. But here's where it gets messy. Meet Priya and Alex, twins inheriting $50,000 each at age 30. Priya picks the T. Rowe Price Blue Chip Growth Fund, an actively managed mutual fund. Alex chooses the Vanguard S&P 500 ETF. 10 years later, Priya's fund returned 11.2% annually. Alex's ETF returned 12.1%, but Priya paid 0.69% in fees yearly. Alex paid 0.03%. Worse, Priya's fund triggered $8,300 in unexpected capital gains taxes when the manager sold winners in 2021. Alex, 0 taxable events. Why? Mutual funds must distribute capital gains to shareholders, even if you didn't sell a share. ETFs avoid this with a tax loophole called in-kind creation redemption. Priya's professional management cost her $14,000 in fees and taxes versus Alex. Ouch. This brings us to the brutal truth. Most active mutual funds fail. According to S&P's SPIVA report, 89% of large-cap U.S. mutual funds underperformed the S&P 500 over the past 15 years. Why? Fees are part of it. But also, fund managers chase last year's winners. They get forced to sell during crises to handle redemptions. They're handcuffed by prospectus rules, like must hold 65% U.S. stocks. Meanwhile, ETFs and index mutual funds don't pretend to beat the market. They are the market, so who still needs traditional mutual funds? 3 groups. First, investors over 60 who distrust apps. My neighbor Mr. Chen, 73, still mails checks to buy shares of the Fidelity Registered Puritan Registered Fund. He gets paper statements. He talks to a human rep. For him, that trust is worth the 0.52% fee. Second, people in employer-sponsored plans. Your 401k likely has mutual funds as default options, often with waived fees. Maria, a teacher in Ohio, contributes to her district's 403b plan filled with TIAA-ACREF mutual funds. No trading fees, automatic payroll deductions. That frictionless consistency matters more than shaving 0.1% off fees. Third, niche strategies ETFs can't replicate, like the PIMCO Income Fund, a bond mutual fund that uses complex derivatives to hedge against inflation spikes, or the Vanguard Tax-Managed Balanced Fund, which harvests losses within the fund to minimize your taxes. Try finding an ETF that does that. But let's be crystal clear. If you're under 45, tech comfortable, and investing in a taxable account, mutual funds often hurt you. That capital gains distribution trap. In 2023, the Fidelity Contra Fund dumped $23.17 per share in taxable gains on shareholders, even as the fund lost money that year. I repeat, you got a tax bill for money you never received. ETFs avoid this 99% of the time. And loads, why pay a broker 5% when Fidelity or Schwab offers thousands of no-transaction fee mutual funds? So where's the middle ground? Meet David Chen, a real client, name changed. Age 42, inherited $200,000. He split it 3 ways. $100,000 into Vanguard Wellington Fund, a balanced mutual fund running since 1929. Why? His dad used it. He gets quarterly paper statements. The 0.25% fee buys him peace of mind. $75,000 into iShares Core S&P 500 ETF for pure market exposure. $25,000 into a robo-advisor for automatic rebalancing. David isn't ideological. He uses mutual funds where they solve human problems, not because they're better. Let's talk practical steps. If you must pick a mutual fund, avoid loads like plague. Search fund name plus load structure on Morningstar. If it has any loads, walk away. No exceptions. Demand fee transparency. Expense ratio under 0.5%. Good. Under 0.2%. Ideal. If the prospectus says 12B1 fee up to 0.25%, run. Check turnover ratio. Above 50%, the manager's trading like a day trader. That means higher taxes and fees. Tax location matters. Always hold mutual funds in IRAs or 401(k)s. Never in taxable accounts unless they're tax-managed funds like Vanguard Tax-Managed Capital Appreciation Fund. Ignore past performance. That 20% return last year, probably luck. Check how it behaved in 2008 or 2020 instead. Here's what Alina did. She took that $18,000 and put $5,000 in a high-yield savings account, emergency fund. Invested $10,000 in Vanguard Star Fund, a no-load, all-in-one mutual fund with stocks and bonds, expense ratio, 0.32%. Placed the last $3,000 in a Roth IRA with a low-cost ETF. Her rule: never pay a commission, never buy a fund she can't explain to her 12-year-old. Today, 5 years later, her $10,000 grew to $14,200. No sleepless nights, no tax surprises. She just bought her first car with cash. Let's recap what you truly learned today. Mutual funds are pooled investments traded once daily at NAV, unlike ETFs. They're ideal for hands-off investors who value human interaction, automatic features, and paper statements, especially older generations or 401(k) participants. But their hidden fees, loads, 12B1 fees, and mandatory capital gains distributions can destroy returns in taxable accounts. Most active mutual funds underperform indexes after fees. Only use them for specific human needs, not chasing returns. The winning strategy: pair low-cost index mutual funds, like Vanguard's, for core holdings with ETFs for satellite positions, and always prioritize tax efficiency. If this lifted the fog, do me a favor, hit like. It tells YouTube this matters, and subscribe. Until next time, this is Daniel at Monster Invest. Remember, Wall Street sells complexity because simplicity doesn't pay commissions. Your greatest power isn't picking hot funds, it's ignoring the noise, minimizing fees, and letting time do its work. The monster in your portfolio isn't volatility. It's the fees you never saw coming. Starve it.